Well, hello everyone, and welcome to the 2023 Mid-Year Economic and Investment Outlook presented by Dechtman Wealth Management. We have a fabulous program for you today and very excited to share this information with you. I would encourage you to grab a pen and paper, take some notes. However, we do record each session that we do put on, and we will be sending the replay in about a week or so. So please know that that will be in your inbox sometime middle to end of next week. If you do have a question, we encourage you to ask as many questions as you might have. Please type your questions in the Q&A box, and the icon is located at the bottom of the screen. We will get to your questions at the end of the presentation, and obviously we save the best for last, so you don't want to miss any of this presentation. Important disclosure information, nothing out of the norm. Those of you already familiar with Dechtman Wealth Management, these are the three advisors that represent our firm: myself, Jordan Dechtman, Sam Dechtman, who will be presenting today, and Adam Dechtman, also one of our senior wealth advisors. We couldn't do what we do without our fabulous team. We just don't have enough time to go through and acknowledge each of them individually, but want to know that they are such an important part of what we do and how we serve you. So the presentation itself is about 50 minutes. We've saved time for Q&A. Again, you don't want to miss any part of this, especially the end. So the agenda is as follows, very straightforward. We're going to be covering inflation, a very big and important topic, what to expect going forward, interest rates now and in the future. We're going to give you our perspective on a global economic outlook. And lastly, number 4, investing principles and strategies. So Sam is going to present the material today. I will come back at the end to wrap things up and do Q&A. Sam?
All right. Thank you for that introduction. And we have a lot to cover today. So I'm just going to jump right in. And as Jordan mentioned just a moment ago, we're going to kick off with inflation because that has been the buzzword, if you will, for the past 2-3 years in the financial markets. So we wanted to lead off with it because we thought that that was an appropriate place to start. So what we're looking at here on a graph is showing the purchasing power of a dollar from 1980 through the end of 2022. But I want to give you a little history. America entered the 1980s in the midst of Paul Volcker and the Federal Reserve lifting interest rates to combat double-digit inflation. This painful but necessary tightening of monetary policy served to bring inflation down. From an averaged annualized pace of 7.4% in the 1970s, inflation averaged 5.1% in the 1980s, 2.9% in the 1990s, 2.6% in the 2000s, and averaged less than 2% in the 2010s. While the timeline displayed over this chart primarily saw inflation in the 2 to 3% range, the impact of inflation compounds over time. From the start of 1980, the purchasing power of a dollar fell more than 72% by the end of 2022, which is why we believe strongly that investors should always consider the impact of inflation on returns over time. And you can see, again, that this is a period of 2 to 3%. This does not encounter periods where it had averaged over that. So it's very important to be mindful of the idea that money that's sitting in the bank account is slowly being chewed away from a purchasing power perspective by inflation. So let's now take a look at how it's done more recently. The dark blue line is the year over year change in inflation. And the dotted orange line, if you will, looks at the 3-year average. So if we focus first on the dark blue line, we can see that it looks like inflation did peak last summer at a little over 9%. And thankfully, from that point, we've seen it start to go down. Whereas the orange line is telling us that, okay, inflation has certainly gone up, recently and has come back down. But when you're still looking at it on an average perspective, it's still very elevated. Now, the most recent June numbers, and we're going back to the dark blue line here, is headline inflation actually dropped to 3.1% year over year growth, while core inflation dropped to 4.9% year over year growth. Now, the headline inflation number, which this dark blue line is illustrating, includes both food and energy, which historically have been the most volatile. It's always been this way. This is not a recent change given what's persisted with the pandemic. And we are of the opinion that due to a lot of different variables, one of which we're going to spend a few moments talking about, which is the M2 measure of money, are trending in the right direction. But another one that we don't have a specific chart for is, of course, we're starting to see supply chains begin to ease, particularly with China now lifting a lot of their measures that they had in place for years as a result of COVID. So now let's talk, about what we think is the most highly correlated variable to inflation, and that is the M2 measure of money. And so what we're looking at here on this graph shows you how much money has been in circulation going back 1959 up until very recently, May 2023. And you can see that inflation has been on a somewhat similar trajectory over time. And then as we get here to the right-hand part of the screen, we can see it's almost a vertical line upward. In 2020 and 2021, we saw an increase in the money supply of over 40%, which is the likes of we've not seen before in history. And another thing to be very mindful of is we can see how quickly it's been coming down over the past year or so. This has also never been evidenced in history before, as you can look along this blue line and not see any other decreases that have been so sharp and happened over such a quick period of time. COVID was very unprecedented in a lot of different areas, and one of them is certainly what's been happening to the money supply as well as general monetary policy. And generally, when it comes to monetary policy, you see quite a lag. So when you had trillions and trillions of dollars thrust into the system in 2020, we didn't really start to see how that was going to impact inflation until later in 2021. And so with the decrease in the money supply, we think that it's going to take some time for it to really show its teeth. But we think that the effects of that are already happening, as we illustrated on the previous slide, with the inflation year over year growth coming down pretty precipitously. Now, beyond the money supply, another factor that's at the disposal of the powers that be is what they do with interest rates. So what we're looking at here on this slide shows the federal funds rate going all the way back to early 2000 until very recently. So the Federal Reserve hiked interest rates by 25 basis points in July, or 0.25%, which means that the Fed has raised interest rates in 11 out of its last 12 meetings. And the benchmark overnight rate is now between 5.25% and 5.5%. The Fed gave no indication whether this would be the last time they plan to raise interest rates this year. However, Federal Reserve Chairman Jerome Powell has been adamant that they have no plans to cut interest rates in 2023. The market believes they're likely done with increases for the remainder of the year, given the slowing pace of inflation. And the Fed has again said that they're not sure if they're going to raise it or not. They're going to be data dependent. We are of the belief, based on what we're seeing with the money supply as well as other factors, that inflation is going to come down regardless. So what we're focused on is the Fed going to continue to take a measured approach in further increases? They will eventually reach a point by increasing interest rates where things in the economy might become a little bit more unstable, which of course they're very focused on. And so it'll be interesting to see how they're going to read future data as it comes to them. So now I want to switch gears a little bit and talk about what's happening from a global economic outlook perspective. Many economies are facing headwinds related to persistent inflationary pressures and tightening monetary conditions, similar to the United States. However, the global cycle is not overly synchronized. China's economy is slowing down and dealing with possible deflationary issues, while Europe has stabilized amid falling energy prices. Now let's spend a few minutes talking about the US economy. And the question that has been dominating financial media, publications, TV, podcasts, you name it, is recession talk. So are we going into a recession? And this is an extremely difficult question to answer, and one that we aren't too concerned with answering. We are in the business of planning, not predicting. And depending on which pundits you follow, some believe there's an 80% chance that we'll have a recession in the next 12 months, and others think it's closer to 20%. So there's a very wide range of opinions on where we're going and where we're at currently. And the consensus view going into 2023 was that the US was going to enter a recession this year. Now, we still have a couple months remaining, but it is unlikely that it's going to happen this year, barring some extraordinary event. It's as difficult a time as ever to project the forward trajectory of the economy as we're dealing with the fallout, from all the unprecedented monetary as well as fiscal actions that occurred. And so today's conversation is mainly going to focus on the numbers and the long-term implications that we're reading from that. However, if we did enter a recession, we wanted to show you what that might look like. So what we're looking at here on this graph is how long recessions have lasted since 1918. And we can see here at the bottom that the average recession has lasted a little over a year. Now, mind you, this does include the Great Depression, which we can see here lasted for over 3 years, almost 4 years. So that greatly skews this average. So if you were to take it out, the average recession is a little less than a year. And for reasons I'm about to explain in a few moments, we believe that if a recession were to happen, because it is not a foregone conclusion, we do think that it would be a more mild, muted type of recession due to the strength of the consumer and how well individuals are managing their own personal finances to what we've seen, at least with more recent recessionary periods. Another area that's been dominating headlines this year has been banks. So we wanted to spend a few moments discussing the health of the banking system. This spring, we saw the collapse of Silicon Valley Bank and Signature Bank. And Moody's recently lowered the credit rating of 10 banks. Moody's, again, is one of the largest credit rating agencies that is out there. The main reason for the downgrade is related to interest rates, pressure on profits, and a mild recession in 2024. The largest banks are as well capitalized as at any point in history, and we think they have the ability to weather the storm if there is a recession. Now, as you can see with the small banks, which is here on this right-hand column, a large portion of their loan portfolio is in commercial real estate. But the biggest driver of recent loan growth isn't offices, it's multifamily properties. Yes, multifamily properties are looped into the commercial real estate bucket when it comes to assessing a bank's loan portfolio. Now, regarding offices, some banks probably are overexposed, but the affected banks that are overexposed are smaller in scale as they relate to publicly traded ones that folks are actually investing in. Now, regional banks' exposure at large to office loans maturing this year is less than 50 billion, and it's less than 100 billion over the next 2 years in terms of what's maturing. Banks are also provisioning more for potential losses, which is consistent with accounting rules requiring banks to set aside funds well in advance but there are no apparent signs of major credit deterioration. Non-performing loan ratios actually ticked down at several banks. And so while there's a lot of attention drawn towards the office place, we wanted to show you a chart to really illustrate what does the exposure actually look like and how concerned should you be in terms of your portfolio and the market. So again, to say it more succinctly, the large banks, we can see that the commercial real estate bucket is a small part of their loan portfolio, and we know that not all of that commercial real estate means offices. Now, when it comes to the smaller banks, again, most of the new loan origination is occurring in multifamily properties. And so we'll keep our eye out and look for any black swans that might be approaching, but we think that the fear related to the demise of the offices and work from home is a little bit overblown, at least at this point. So let's switch gears and talk about labor demand. What we're looking at right now is a graph showing open job listings going back 1973 through the end of April this year. And while openings have come off record highs, they remain remarkably high by historical standards. And this is very important because even if a recession weighs on labor demand, there is a large buffer before demand falls behind supply and results in unemployment. Said a different way, there are still more job openings than people looking for jobs. So even if you see employers start to pull back, we still have a little bit of slack left on the line before we're really going to see it have a major impact. Another way to take a look at it is through the labor force participation. And the best indicator of a resilient economy is through the resilient labor market. Employment growth has now beaten economists' expectations for 14 straight months, showing how underestimated the labor market and the economy are. The employment population ratio for prime age workers, which is individuals 25 to 54, which accounts for the labor force participation issues, is now higher than at any point in 2000 to 2022. And we can see the 25 to 54-year-olds in the light blue line, and we're looking at the y-axis when it comes to that number. And the individuals over 55 are the darker blue line, and we're focused on the right-hand side. So just a few points worth mentioning. One, it's great to see that prime age workers are becoming more involved in the workforce. We still have a little bit of room to go, but it is encouraging that we're almost at a 2-decade high when it comes to those workers. But we are seeing a significant amount of baby boomers begin to leave the workforce, and those older Americans are working a lot less than we've seen them work historically. So that'll be something to keep an eye on, particularly what happens with inflation. If we're going to see more folks begin to go back to the workforce, or maybe not leave the workforce as quickly as we've seen in the last couple of years. Now, we wanted to spend a quick second on how the consumer is doing. Another headline that's dominating the media has to deal with folks overextending themselves, running out of money from all the different stimulus checks and things of this sort. So again, we wanted to show you a graph to try and make sense of, okay, what is actually happening right now? What does the situation look like at large on an individual level? So what we can look at here on the left-hand side shows the assets that are on people's personal balance sheets. And we can look at here on the right as liabilities. So the first observation we want to make is people have significantly more in assets than they do in liabilities. Second, the major source of liabilities or debt that's outstanding for an individual is primarily made up of mortgages. Mortgages represent about 2/3 of the outstanding debt for the consumer. And we can see a listing of some of the other options here as they're significantly smaller. Student debt being 9%, car loans being 7%. And so when we're talking about folks becoming overextended and adding more debt and debts reaching levels we haven't seen before, it's important to ground ourselves in that, yes, the total figure of debt may be a little bit higher, but our total assets are also extremely high as well. And so it would only make sense that the total debt number increases at a similar type of a ratio. But what does it actually look like on their income income sheet? We just looked at the balance sheet. Now we're looking at someone's income statement. And on the left-hand side, this is a graph which shows household debt service ratio, which means debt payments as a percentage of disposable personal income. So of your income, how much of that are you required to use to pay down debt? The lower the number, the better. And we can see here through the end of the second quarter that we're looking at a almost lowest number, COVID aside, that we've seen in the last 40 years, and significantly lower than what we've seen going into the financial crisis 2007, 8, 9. And so people are doing a much better job not overextending themselves. They're not getting too heavy on debt, whether that be with their mortgages, credit cards, autos, anything of that variety. And in fact, most consumers have now locked in extremely low mortgage rates. And so they have much better chance of continuing to pay that and remaining on time going forward. On the right-hand side, we're looking at flows into early delinquencies. And we can see here that student loans is the orange, credit cards is gray, and autos is light blue. And we're starting to see autos and credit cards pick up a little bit here on the right-hand side, but we can see that we're still significantly below where we were in terms of the peaks going into 2008. So that's something that we're going to be mindful of, and how many people enter these delinquency periods. But again, we know that there's a lot of jobs that are still available. So if folks truly do need money and are interested, in spending the same way that they always have, right now there are options for them to try and right the way. Another headline was that Fitch downgrades the United States credit rating, so we wanted to address that as well. They lowered the United States government credit rating to AA plus from AAA. This was the second time in history that a rating agency did this, as S&P Global Ratings did it in August 2011 after a government standoff over the debt ceiling. Fitch cited factors including debt ceiling debate earlier this year, growing U.S. government debt, as well as governance issues. Well, we believe these concerns are legitimate. They're offset by the country's strong, diversified economy, robust governance and rule of law, and deep, liquid capital markets. The U.S. is as in good of shape as any economy in the world and should still be the highest credit rating of any country. Investors have shrugged off the downgrade, and we haven't seen any noticeable changes in the Treasury market. The timing of this is also a little strange because nothing has been revealed through Fitch's analysis that was not already known in the market. So while it's a symbol of issues that are already widely known, this wasn't something that changed anyone's opinion in terms of the credit status of the United States. And again, we are firm believers that the United States is still the best credit rating of any country that is out there, bar none. Now, let's spend a minute talking about investing principles and strategies. What we're looking at here on this chart shows the S&P 500 broken up into two different buckets. The light blue shows the performance of the top 10 stocks, and the bottom 490 are in the green line. And so despite sharp gains, we can see that the 10 largest stocks, mostly concentrated in tech and communication sectors, received a boost from exuberance about the prospects of artificial intelligence and have rose more than 40% in the first half. This far outpaced the rest of the market, where the rebound was less pronounced. And while on this particular chart we highlight the top 10, we really could have made this the top 7. Some are referring to these companies as the Magnificent Seven, if you will, and these are names that you know very well. It's Amazon, Apple, Microsoft, Tesla, NVIDIA, Meta, and one other that is Amazon, if I didn't already mention that's escaping me at this moment. And so NVIDIA in particular is a very interesting one. When it comes to AI technologies and systems, they require what are called GPUs. And NVIDIA right now has close to an 80% market share. So as there's this increased enthusiasm and interest and excitement around AI, they're really the ones that are with the picks and the shovels actually building these things to make it possible for other companies to capture that type of technology. But now that we know that the vast majority of the performance, almost all of it, is led by a small subset of stocks, has this ever happened before? Is this an issue? Should we be concerned? What does this tell us about the market going forward? So what we're looking at here shows the actual weight of the largest stocks in the S&P 500 over time. The blue line shows us the percentage the largest stock holds in the index. The red line shows us the percentage the largest 5 stocks hold in the index. And the orange line shows us the percentage the largest 10 stocks hold in the index. And after looking at 80 years of market data, there are periods of strong market returns that were commonly carried by 10% of stocks or less. Put simply, it's normal for the market to be dominated by a few companies. And as you can see in this chart, at different points in history, the index weight of the top single, top 5, and top 10 stocks have hovered in similar ranges to what we're doing today. And another very important point is it has not been the same single stock that has led the market throughout time. It has not been the top 5 stocks that have always been the ones that have been there. And lastly, it has not been 10. These companies move in and out and constantly change over time as great companies begin to fall back and you have new innovative companies begin to charge forward, which leads us to a staple and a long-term investing principle, which is diversification. And the reason why you diversify is it is impossible to tell which company, which 5 companies, which 10 companies are going to be the best this year, which are going to be the best next year, and which are going to be the best for the next 20 years. And so want to point out, a few things as we're looking through this quilt chart, if you will. At the top, it shows you the best performers of an individual sector in that year. And at the bottom, it shows you the worst in terms of that area. So as you're looking at this chart, I'm going to pose a question here. Do you see any patterns? I certainly don't, because it's very difficult to predict what's going to be best, what's going to be worst. Where instead, we want to make sure that you're properly diversified so we don't have to always be making the correct, right decision. And so as we can see this line connecting these different boxes shows you what asset allocation looks like over time. And so what a very important point to make about this is in a properly diversified portfolio, it's never going to always be at the top, but we can see that you're not going to be at the bottom either. And as we're looking at the annualized returns over the last 14 years, we can see being properly diversified puts you in the top category when it comes to returns, and it also puts you in the lower category when it comes to volatility. And so just want to further emphasize that trying to pick the very best part of the market every single year is very difficult, which is why we want to make sure that we cast a wide net and are focusing on best in class companies in a lot of different areas. Now, one area that we think is particularly important to consider when coming to diversifying is US versus international exposure. And so what we're looking at here is the relative outperformance of either the US or the international space. The big gray mountains here show when the US has outperformed. The purple shows you when the rest of the world has outperformed. So even though as we look on the right-hand side, the US has outperformed very significantly for almost the past 2 decades, a little over 14 years, we can see that there have been periods where the rest of the world has done magnificently well, and they've also led for a long period of time. And so we wanted to illustrate this as we're about to make the case for potentially adding more international, that the US hasn't always been the leader during different periods of time. So the reason why we want to start more seriously considering adding bigger allocations to the international area, deals on two different valuation metrics. We'll start here with the one on the left. This is looking at valuation through what is called a price to earnings ratio. And all you need to know is that when the price to earnings ratio is lower, that means that a stock is cheaper, which means that it could potentially be a better time to buy. And so as we're looking at here through the June 30th reading, we can see that the world stocks compared to the United States have been significantly cheaper than we've seen on average. It's roughly about 2 standard deviations cheaper, which is hardly ever seen in history, which means that if we're to believe that there's going to be some reversion to the mean, that could present a lot more opportunities in the international space based just purely on the valuation metric. On the right-hand side, we're looking at the difference in dividend yield between, again, the United States and international. And we can see that as of June 30th, the international space is paying significantly more in dividends. In fact, about 2 standard deviations above the long-term average, which again just means that this is a very rare occurrence that we have not only very cheap valuations, but a much higher dividend yield. And as you know, through conversations with myself, Jordan, and Adam, we are huge believers in dividends, in their ability to continue to get reinvested and compound over time. Dividends are extremely powerful, and the idea that you can collect a little bit of a bigger dividend, particularly from some companies abroad, is also a very exciting opportunity that we want to make sure we're taking advantage of. This is a chart which shows when the S&P 500 is down 25% or worse since 1950. Today's economic and geopolitical challenges may seem unprecedented, but a look through history shows that there have always been reasons not to invest. Despite the negative headlines, the market's long-term trend has always been higher. In fact, the great investment opportunities often emerge when investors are feeling most pessimistic. And we can see very recently in 2022 how much the market had dipped, a little over 25%. And as we look at all these instances, on average, we can see that it's roughly down a little over 37. And over every 3, 5, and 10-year period, the market is up positive. And in most cases, it's up very significantly. And there's only one particular case, in the 2007 to 2009 period where the market was not up 1 year later. And so in most circumstances, this bounce back happens pretty quickly, and it can happen pretty sharply as you're looking at all of the particular numbers here. So again, it's very difficult to get bogged down in the noise, and it is much harder to actually focus on what the real data is telling you and whether or not that should impact the long run decisions that you're making. And so there's never a great time to jump in if you're focused on the headlines, and just wanted to illustrate how the market is done following other tough periods. Focusing on the other side of things when it comes to bonds and other fixed income instruments, we wanted to show you different market interest rates. So what we're looking at here with the light blue line is the 3-month Treasury bill, which as of June was 5.3%. The gray bar shows a government money market fund of 4.9%. The green bar shows the 6-month CD, and then the purple and the orange show what's going in a bank account. We wanted to show you this chart, which illustrates the different interest rates available, to make the point that if you have a bunch of money sitting in a checking or savings account, it's not really earning anything. And there are other very easy, simple, safe, and conservative solutions that you should consider to at least get the money working for you in some way. So even again, if you want to remain conservative with the cash, you can at least get it working for you in a slightly better way. And the reason why we want to get that cash working for you is this particular reason. And we wanted to show it again because it's so important. Again, this shows how the purchasing power of a dollar has decreased by 72% over the last 42 years. That is extremely powerful. So if you think that the money is safe just sitting in the bank account, you need to really think again, because inflation is slowly eating at it. So while the number in the bank is still the exact same one, what that dollar can get you goes down and down each year. So you have to make sure, even if you want to be conservative, that you're doing your best to at least keep up with what inflation is doing. So now let's talk about T-bills a little bit more in depth. So a T-bill is the nickname that is given to a United States Treasury bill. And a United States Treasury bill is backed by the full faith and credit of the United States government. They have a fixed interest rate, and the interest earned on a T-bill does not have any state or local taxes. Now, that is a big difference between a money market or a CD. If you are to buy a CD, the interest earned on a CD is taxed at both the federal and state income level, where a T-bill, again, does not have any state or local taxes. Another big difference between a T-bill and a CD is that with a T-bill, whether or not you chose a 12-month, let's just say, option, if you need your money in 6 months, with a T-bill, you're able to sell it, and the value is whatever the value is on that particular day. With the CD, if you were to buy a 12-month CD and sell after 6 months, most, if not all, banks are going to penalize you. They're going to charge you anywhere from 3 to 4 months interest. So if you want to be conservative, we really view the United States T-bill as one of the best options available. And you can see, for however long you want to lock in that particular interest rate, pretty attractive yields versus what we've been looking at for roughly the past 14, 15 years. Now I'm going to turn it back over to Jordan to wrap it up.
Okay, wonderful. All right. So just to summarize, as Sam just mentioned on this most recent slide, you want to consider putting cash to work. There's tremendous opportunities on the stock side, both domestic and international, with wonderful dividend paying strategies. And on the fixed income side, T-bills, which are paying unprecedented rates with many advantages. Secondly, make sure your beneficiaries are up to date, something that we talk about all the time. Can't emphasize it enough. I can't tell you how many times we've seen beneficiaries that are not up to date. This year alone, we've seen 17 different instances where the beneficiaries were not updated, and it created a lot of undue stress and problems for the surviving heirs. You want to store important information where your beneficiaries can find it. That seems rather obvious, but you'd be surprised that there's a lot of uncertainty and unknowns during a difficult time when someone passes. So just something to keep in mind. Number four, something that we've found a lot of success over this year and last year in particular is a family meeting. Meeting with those beneficiaries, those that are maybe power of attorney. Schedule a time to meet and greet, put a name with a face, and we welcome that and encourage it. If it's been a while and you'd like to schedule an appointment, please call the office. We can, of course, meet in person, via Zoom, over the phone, whatever is best for you, but it's too important to put that off. So again, I want to encourage everyone to type in a question. We're going to do our very best to get to everybody's questions. God, goodness, we have a few questions already, and it looks like more are being typed in. So let me just take a quick gander at that. Okay, so the first question is, when a T-bill matures, what happens? Well, so what happens is the T-bill matures, and then it is either reinvested in another T-bill or some other type of an investment. The T-bill, as Sam pointed out, it is liquid, it is accessible, and as an alternative to monies in a money market, bank account CD, it gives you more options, more flexibility, um, and increased return with tax benefits. Thank you for that question. And as these other questions come in, let me just kind of read what we're looking at. So the other question is, what are your thoughts on ESG investing? ESG, first off, is an abbreviation. It stands for environmental social governance. And so in theory, it makes great sense, but in reality and in practice, it really doesn't work. It doesn't provide the type of returns that one might hope for. It's not something that we recommend, and we look at other ways to approach that. All right. Again, keep those questions coming. We appreciate that. Looks like another question. What does the emergence of AI, what does this technology mean for investors? That's a wonderful question. Again, Sam touched on that with the overexuberance of the Magnificent Seven thus far. In very short, I would say, and Sam, if you have any more to add, but I would say AI is going to enable greater productivity and will allow companies to reduce costs, which ultimately will benefit consumers and investors alike. So being invested in a diversified portfolio, something that we espouse very much so, will give you, as an investor, the biggest advantage to participate in these AI companies and for you to benefit now and in the future.
Yeah, I don't have anything else to add. That was great.
Okay. All right. And again, thank you. Looks like we have some more questions. Next question. How will I know when I can retire? I love that question. That is beautiful. We have very sophisticated software in-house, and we can help put together a retirement income plan, a retirement income strategy. We would like you to come in. Let's meet. We can do this over the phone or Zoom, and whatever is best and easiest for you. Okay. Okay. Got another question on T-bills. How do you purchase these T-bills you're talking about? You'd never believe it, but you can purchase it through Dechtman Wealth Management. All you have to do is let us know, and we can easily help you in that fashion. Okay. Got another question here. U.S. credit card debt hit 1 trillion for the first time ever. Is that something that I need to worry about? In an answer, very simply, no. U.S. households, and again, Sam alluded to that during the presentation, that the consumer is in the best shape they've ever been in history, and that credit card debt has increased, but again, the balance sheet or the net assets overall have increased significantly, much more. So I don't see any other questions here at this moment. Well, I think what we're going to do is kind of wrap that up. If there are any other questions, please again, reach out to us, schedule a time for us to talk. We appreciate the trust and confidence that you've placed in us. Again, reach out to us, give us a call, and we really appreciate you spending time today. Thank you. Have a wonderful rest of your day.
Thank you.
Bye-bye.